case, we want to just go through the multi-peril, more of an update, changes, and touch on a few things for some of you that may be repeat. But I want to introduce Lynn Button. Most of you have heard him here if you've been here before. Lynn is the director of our insurance division, and that encompasses both the crop insurance as well as the farm liability, property casualty. So with that, Lynn and I are going to tag team here on this final presentation.
Thank you. Appreciate you giving us time to go through some of this stuff. I've had the privilege of being taking Art, grabbing him from the airport, and taking him around from meeting to meeting that we've had. So if you've got questions, please bounce it across him. I've been riding with him for 3 days now, and all the dumb questions are off the table because I got to ask him in the car, and nobody else was around to hear those. So usually it comes a negative becomes a positive. We were talking yesterday, there was a farmer that didn't want to spend time asking the question, but he said, hey, is there a way to do this? And when we were going from Redwood to Mankato yesterday, I bounced across Art saying, hey, you know, the farmer wanted to know if there's a way that we could show the Olympic price and the Olympic yield is part of that pop-up. And out of that conversation, he called and in about 5 minutes got it figured out how to do that. So please ask questions, bounce ideas off, and make something better. So I know we're in a better place than where we were at last year. Art allowed us to use his Excel spreadsheet to help get a lot of the information that he explained in those maps. So it's a real positive that it's pretty easy to go in and select your county and see that information rather than trying to work off that spreadsheet. A few quick things as far as crop insurance for 2016. A couple reminders, one of them being the conservation compliance. Please make sure that you are conservation compliant with the new 2014 Farm Bill. It is part of linkage is back in there again, and we need to make sure that your operation is conservation compliant. So please, when you're in the FSA office, check it out, ask them. Even if you can get a copy of that 1026, some FSA offices might say, hell no, we're not going to do that. That's okay, just make sure that you're conservation compliant, because the problem with that is if you're not, you're gonna pay the full premium and not get any subsidy for the 2016 season, and that becomes pretty dangerous. We have been getting for several months reports back from our insurance companies of those that are not compliant, and we still, even though it's a small list, we're still getting some where maybe a social security number is not right, or there's not linkage back and forth, because they are talking back and forth between FSA and the AIPs, the crop insurance companies. So please make sure if you're changing entities, which is also another thing, young farmers coming in, sons coming in, whatever, new entity means we need to get to the FSA office and get that 1026 completed and filed. New for 2016, just a little bit of a change on added land. Not a big thing, but just so you're aware of it, what we've been dealt with the last several years with trend adjusted. Remember, trend adjustment takes a looks at your APH, looks at the years, and depending upon how old that APH is, will adjust each year up according to what the trend rate is in the county. So as we look at it here, trend adjusted, when we talk about added land, the example of our 5 units across our policy has an average actual yield of 180. We selected to do the trend adjustment on our policy before March 15th. Let's say, for example, that our average of those 5 units with trend adjusted took that up to an average of 195. The change for 2016 on the added land is that the added land, or the new land coming in, will not get that 195 like we got in previous years. It will actually get the actual simple average, which is the 180. So something that's not as good as what we've had in the past, but again, we don't make the rules, we just understand what the new rules are and make sure that you're aware of those. So something that's not as good as what we've had in the past, but still the simple average added land getting that 180 is probably more than likely better than starting with the T yield. So again, something's better than nothing. As we look at trend adjusted, we're seeing now and moving forward probably there'll be added crops. We've been used to having trend adjust on corn and soybeans. For 2016, they're adding sugar beets. They're also adding dry beans. We're hopeful that keeps moving forward as far as peas, sweet corn, some of these other crops that we deal with. We hope that comes forward in the continuing years. And I think that'll start to happen now that we're seeing new crops pop up for 2016. Some other things that we're seeing is they are adding corn for silage. In some counties, we don't have them for the whole state. They're listed here as to what we actually have. For those that are growing the one purpose for silage and don't do a dual purpose type hybrid, we can ensure that as silage and make that work. In the past, as long as it's dual purpose, we've been able to, if you're getting ready to chop that, we turn in a request, they come out, do their appraisal, and convert that back to regular corn for harvest. So again, positive steps. We're not quite there across the whole state, but they're finally making progress. So RMA is a little slow, but they get there eventually. And the other SCO is available on sugar beets. Everybody pretty much told us that they went ARC, so that's not an option to get some extra coverage there. Just some examples. Trend adjust is good. In most cases, it does help. This is just an example on sugar beets. A actual database where we had a 32-ton APH, we trended, it went to 34. So again, additional coverage that you can get for anywhere from maybe a ton to 2 ton on your guarantee without having to go to that next level of coverage. So again, on dry beans, a couple hundred pounds added on by taking that trend adjust, and that's a good thing. So the other thing we want to talk about a little bit is the 2016 yield exclusion. It was here in 2015, but again, a lot of people come to me, call me and say, hey, I can now throw out that bad yield in my history automatically now, right? That's how crop insurance works. It's not how it works. There's an option. It's called yield exclusion that you put on just like you put on trend adjust. You put it on before sales closing as an option. And what that does is it goes into the specific county that you're dealing with and looks at the last 10 years history. And if there's 1 year in there where the county dropped below 50%, if you selected that yield exclusion, you're allowed to take that out of your 10-year database. So in this county, if we had 1 year that dropped below 50% in the county, you could take that out of your database. If you had 10 years in that database, they'd take that 1 year out and they'd add the rest and divide by 9 instead of divided by 10. So you can, if you've got questions on that, you can see what counties around come into play. I know not a lot in southern Minnesota, but you get up towards Alexandria, Polk County, Swift County, that type of thing. It does come into play, and I think in Polk County last year there was 3 years where that did come into play. So potential allows you to increase that APH without having to go to that next level and still get some good coverage. Beginning farmer rancher, again, was around last year, just as a reminder for this year. For those that are coming in as new operators, coming in beginning farmers, there is that opportunity to complete that application and get some benefit as that beginning farmer rancher. So again, the BFR is going to require us to do an application. If it's a married couple, we're going to have to do an application for both the husband and the wife. So it's additional paperwork. We're willing to do that. I think there's some benefit there. We just go ahead and do that. And we do that ahead of making our decision in March because it's another 2 applications. It takes a little paperwork, and we'd like to get that out of the way so it's not part of our million copies or papers coming through our system in March. And we get this done ahead of time and do it right and have the opportunity to get it done. So BFR, beginning farmer, it's a nationwide deal, so South Dakota farmer can't come blowing in and say, hey, I'm a new farmer for Minnesota. It's nationwide. If you've farmed before, more than likely, you're not going to be eligible. Again, what we can do with the BFR benefits is basically waiver of admin fees. You get additional 10% subsidy, and if we have a bad year, the YA option would give you 80% instead of 60%. So again, just some additional benefits. Not real huge, but anything helps to get started. And the application is not that difficult. There are some things that if you've been in college for a couple years, maybe you've been in the military those years, even if you farmed we can exclude off and still get you some benefit there. But we would have to provide that along with the application. That, hey, you've got some college transcripts, you've got some military records, or being under 18 years old, we can exclude those years and still capture that BFR discount. So again, the opportunity to do that, even if you are doing the BFR, we still, if you've been involved in the operation with Dad or whatever LLC, we can bring that history across because you've been involved in that farming operation. Just because we take advantage of that BFR doesn't mean that it excludes us from bringing in that good history. So again, all of those things we like to do ahead of time, so we've got some time to say this is the right way to do it, this is how we need to convert the history, do the BFR application, and then make our decision following in March. The other thing, new groundbreaking, there are a guy who came up to me yesterday and he said, I'm taking this out, or I'm breaking this up, or I'm taking trees out. Just remember that there is a difference between the new groundbreaking and native sod as we look at it for insurance. They are two separate things, and one is a lot easier to deal with than the other. And the easier one is the new groundbreaking, where we're taking out, we're tearing up some farmstead, we're tearing up some trees, we're tearing up maybe some of that stuff in the corner of the field, or taking out a fence line. That stuff, new groundbreaking, is pretty simple. And as long as we're less than 5% of the acres, it's a real easy way to deal with. If it's more, we still have the opportunity to deal with that pretty easy. If we're talking about native sod, where it's never been tore up before, we see a lot more as we go further north from here. If it's labeled on the 578 in the detail as grass native, that's a pretty good indicator that we're dealing with something that has a specific rule of how we deal with that and how we bring that into insurance. And that process is a lot more difficult. Takes a lot of looking at the FSA records and the 578s to bring that in properly. So we're not having to take 4 years to try to build that thing and build it right for your guarantees. So we like to work one-on-one with those rather than saying generally this is how to bring that in as far as insurance.
So there's three main pricing products, and again, these aren't new. These are actually endorsements to your multi-peril policy, and it really started in earnest, I'd say 4 or 5 years ago, when NAU brought out their multiple price discovery. And after a couple of years, some of these other companies, ADM, Great American, really jumped on the bandwagon, but had to develop a little bit different offering, and based on some of the experiences that they saw that NAU had come along with. So there have been some changes with that, and these are tools. Again, the main thing I want to emphasize with these tools and what they can do is constantly changing. It obviously depends on what the market is, what you feel the risks are, and really what, as it ties to some of your marketing strategies. And I'll walk through these three. So I put them into I like to describe them as three different types, or they match three different styles of grain marketing. The first one, NAU's MPD, and strictly what that is, and I'm going to fast forward to here, just to give you a little viewpoint. So February is the month when your price is established for your multi-peril policy. That's the price that by default you're going to have on your policy. That price for February, and again, that's the price that's discovered for the entire month. Once we get into February, that price multiplied by your guaranteed bushels becomes your revenue coverage. That becomes kind of like your benchmark, what Art was talking about, our benchmark revenue numbers for the farm program. The insurance has a benchmark or a base revenue protection. So all these endorsements are tied to or built around what is February's price and what are the opportunities or abilities for you to do better than February. So your goal by placing and using these endorsements is you're trying to trump February, okay? It's not funny, right? Anyway, so right now, this is a sheet that we keep track of, we're updating daily, and we can send out, and have been sending it out daily to those that are interested in keeping track of that. And on the bottom of the sheet, the first row all the way across shows you what the first half month has been discovered in that, all these respective months. Then the second row is the second half of the month, and then the bottom one happens to be the entire month, okay? So if you want this, you just gotta talk to Dawn, and she can get you on our group email list. So our goal again is to try to trump what February offers, or ultimately ends up with. Any use multiple price discovery is more of a predetermined price discovery or windows of opportunities, and they've got three different, they give a 5 and a 4 and a 3. In a nutshell, the 5 basically means you have the months of November through March. So November, December, January, and March are your extra months to determine if you can pick up a better price than what February. So for those that may have the MPD 5, you can see if they had purchased that endorsement, they right now would have a $395 as their best discovered price to date. Now, if February comes in better than $395, and ultimately even better than what March would capture, then you're going to get the February and then endorsement, just like a put option that many times expires out of the money. This endorsement would have no value to you. In the last couple of years, even last year, we did pick up some additional value. In the years, the 2 years prior to that, there's some pretty significant additional prices that were picked up compared to February. So I describe MPDs as a very passive type of endorsement, because you get these set months and you just got to sit back and watch it happen. And what happens, happens. Okay. Fast forward, the second one, or the one that's on the other end of the scale, that's the most, should I say, active or aggressive, would be the ADM. It's called revenue net. And I've got a couple examples I'll show you here in a couple of slides. Those examples and those quotes are not in your handout, but you can certainly write down some numbers. I ran the quotes last night and threw them in here, so you'd have some real-time current numbers. But what RevNet does is you actively monitor what that price discovery as we're going along. And if you see that you like that number, or you feel that that's a number that stands a pretty good chance of beating February, you actively make a decision to buy that endorsement at that point. Okay? So if we're looking at the first half of the month, okay, and when this sheet was put in here, we didn't have Fridays. Monday was not a trading day, so we're just missing 1 or 2 days. But as of right now, the first half of January is done. You can't buy or grab that price anymore, because that price has fully been discovered and we're actually past it. So let's say you were interested in those numbers, you watched them as they were going along. You just need to make sure that it's paperwork is signed and so forth by the end of that business day of the 15th. So it's very active. That's the second one, and I won't go into all the specific details here, but it's in your handout, this page is, and if you have some more questions, we certainly will get into a lot more detail. The third one on the list here is the Price Flex by a company called Great American. Theirs is kind of the in-between, okay? What you're doing is you are actually choosing months that you would like to have in your quiver, so to speak, and you are the one actively choosing those months. But then once you've actively chosen those months, then you just got to sit back and you wait for it to happen. So let's say, for instance, even though this discovery sheet doesn't go past March, we will add further months of April, May, June, and July, and continue to track those throughout the summer. With Price Flex, you may say, I'd like the months of May and July, because I feel if we have any potential weather rally or a weather scare or weather event, an actual weather event, we could see a nice rally as compared to what we're dealing with currently today. So if we feel that February is going to be pretty benign price discovery, like where we're at right now, prices are just pretty much doing this, maybe trending down, yet we could get a 50-cent pop in the summertime based on the December futures. That may be a month or a strategy is to pick up that endorsement and put that on. So that's the price flex. So I'll go through, I've got a couple of quote sheets here, you can see what that looks like. There's one little typo on your handout, it does say 0.025 on your handout, it's actually 0.25. So it's a 25-cent increment, not a 2.5-cent increment, okay? So not, one more point, actually the MPD one from NAU, that one has run its course. You can't put that one on your policy anymore. The revenue net will run its course here as we get to the end of January. Price flex does continue on through February, so that one maybe has a bit of an advantage over the others because we're going to get a chance to see what February looks like. So we'll be halfway through February, and we'll still have the opportunity to make a decision. Okay, but then at that point, that one also ceases to exist. So you can't put these endorsements on your policy in April or May or June at that point. It is somewhat time sensitive here in the winter. This is a nice little reference sheet that I wanted to leave with you as well. This just shows you the last 10 years, what the monthly settle price is for that commodity. So in corn, in 2006, for the 2006 crop, I should say, that would be looking at the December futures. Okay, so this month here actually would be November of 2005, looking at the December 2006 futures. So the average price for that entire month was $2.42. As you go across, you'll see one gray box per row. That box represents, or that color represents the month that was the high out of all 12. So you get a quick glance at 5,000 feet of where are the highest monthly averages occurring. And this, again, for some people, giving them a real decision aid to help them determine, if I want to go with the odds, when and what months might there be some merit in me having an additional opportunity to do better than February. You can see, for instance, here in 2007, okay, February was the high for the year. So regardless, if you put any one of those endorsements on there, February trumped them all, and you would have spent that premium cost, wouldn't have gained anything by that. So, but there's obviously some other opportunities you can see in these further out months. And again, I would welcome the opportunity to sit down one-on-one with you. And if you haven't heard about this, and I think the majority of you in the room have, because I have a relationship with you in some regards. So I'm just going to show real quickly. You can see, as we just talked about, November, December, and January, what we've discovered thus far for those 3 months. This happens to be, so now, so that was the MPD I just finished. You look at this one here, this is the ADM, okay? The one in the middle here, the revenue net. So this is an example. I ran this last night, and I just showed what was the actual final price that you could have locked in had we been on the phone last Thursday, Friday on the 15th, and had we said, okay, I like that 381. I think that's a good number. That would have been your decision to make. This shows you what the premium cost would have been per acre, a little over $5 to lock in and have that 381. And now you've got that. One of the options, or one of the things you have with these tools, is you can choose to put it on a portion of your acres. So you could have said, I did the full acres here, 500 and 500, but you intended to plant 500 acres of corn, and you said, I'd like to insure 250 acres with this endorsement, this go around. And then you think, I'd like another chance at the second half of January. And as we watch the second half of January, you say, hey, I like that number as well. I want to put that one on the other 250 acres of the farm. Okay? So there's a corn example using Sibley County rates and so forth. Okay, I also put a bean one in there. So for the first half of January, we ended up at 881, and you can see that actually coincides with our sheet over here. There's 881, and there's that 381 from the corn that I talked about. So here's the bean one for $3.15. You could have locked in 881. Okay. Any questions so far on that?
You have to sign up for these beforehand, right? I mean,
Yeah, like the one with ADM, by the 15th of January, you'd have to sign some paperwork, Todd, to get the first half of January. Yeah.
I'm just saying, like, if you didn't want to do it, then, you know, if you never locked in a price, what would happen? Nothing? It'd just go away?
Yeah, you're not buying the endorsement. If you're signing an application and actually choosing it, the NAU one would be the, if you choose that you want that endorsement, you are making a commitment and you are going to incur some premium, okay? But if you don't ever land a better price, okay, they've still actually booked that risk on their books and written that liability, but in that particular case, there wouldn't be a liability to them, you'd have to pay the premium. Yep. So all three of them, you're actively making a decision to put that on.
But it's like you said, you could have like, do 25% at a time? Is
Yep.
that- So I mean, if you never did the next three,
Yep.
you're not,
You're only paying premium on 25% of your acres. Yep.
you don't have to do all four.
Correct.
Or whatever.
Right. Yep. Yep. Again, that's pointed out here. We've got that ability now with all three of these. This happens to be the third one. The one where I mentioned was kind of in between because now you have some control of which months you want to place out there, which ones you'd like to have that opportunity. But then once you've chosen those months, now you got to just sit and wait for that to happen. So that's the third one here. And here happens to be a quote for corn. Just really the main thing I just wanted to point out, if you chose June and July, and you can choose 1 month, you can choose 3 months, you can choose 5 months, you can choose the second half of May and the first half of July. Whatever the reasons you have marketing insights or reasons to believe that those are the things you want to bunch together, you are in control of that. Once you've done that, then you just got to sit back and wait for that discovery to take place. But here's an example of June, July, taking on the potential that the market, if it moved up to a full $1 above where February was, you would be able to capture that. For June, July, premium costs $12.50 per acre, about 7 cents. Okay. The nice thing about looking at it on a per bushel, you can compare it to some of your other pricing tools and strategies to see how does that compare. Second one here, I did another corn. Okay, this is the same one. Here I did a different scenario, March and July. Okay, if you think that there's going to be a planting intentions report that's going to be bullish to the market, as well as you might say, by July we got tasseling going on and could be dry, I'd like to have that. So those are the combinations you put in there. Actually just cost $1 more per acre. But you are the author of which months you choose. Here's a soybean example. I did a March and a May, for instance. Soybeans have a maximum movement that you could actually capture would be $2. But you can choose to manage this in 50-cent increments. So you could do 50 cents to $1, $1.50, or the full $2. For those 2 months, $5.50 to be able to have those as the opportunities yet to come. Second one here, then I did a June and July for $5, a little over $5. So, any questions on these pricing endorsements? I would say this, if you're not familiar with them, or if you've never heard of them, then we need to visit. Because it's been around long enough, I'll just point out that it takes some time, it takes some understanding, and if you're not getting that conversation in your crop insurance renewals and other things, then there's certainly something that we welcome the opportunity to go through that with you. So again, I'll be here after the meeting. Lynn's just going to finish up here on the last couple pieces.
Again, the price and products have been a good thing for us. I think as we look at what we've marketed over the last 4 years with price products, it can be a really good thing for your marketing plan. We had Ed Ussett for the last couple days. He was not able to come to this one this morning, but in listening to his thought, I think these products and probably Price Flex allows you to go out to that June or July and be able to give you more time to hopefully make a better decision as it relates to your marketing. And if we'd have a bump up in that June or July, would give you the opportunity to have a better price, but also market those bushels. And that's what revenue is all about, the whole revenue protection. So not as a speculation, but as what can we do on an overall basis to make us better. For next 2016, we've got a couple add-ons that we didn't have this last year. Production hail, I've been a believer in production hail as long as you got a good APH, of working hail coverage based on your APH and doing it on a production-based hail plan. We've always had, the state of Minnesota has really created some havoc for us the last 2 years. They've been telling the companies what they should charge for that production plan, which is, in my mind, not what the insurance department should be doing. They should be making sure that the companies can pay the losses. But irregardless, what we've done is work with a company to start offering other things besides the 0 qualifier production hail. So for 2016, we're going to have the option to have a 5 qualifier, a 10 qualifier. I do believe that producers are not so much worried about that 4, 5, 6, 7% loss. Once we get into that 12 or 13, it becomes a bigger number when we look at corn and soybeans. Having this option, I think, is going to reduce our premium quite a bit and still be able to have some good coverage, production-based hail coverage. So a 10 qualifier, if we'd have 11% loss, would pay 11% of the modified APH.
Is that determined by the estimates in the field? Or
Yeah, so the loss adjuster is going to work the same process. Production-based hail is based on your units, so they're going to go out to section 13, they're going to take those 6 counts, they're going to come up with that percent, and if that's 8% and you're buying a 10% qualifier, they'd ask for a withdrawal of claim at that time because you didn't meet the 10. But if we go out there and take those counts and all of a sudden we have 11% and we bought the 10% qualifier, they're going to take that 11% loss times your modified APH. If that's 200 bushel, you're possibly short 21 bushels. So becomes a 0 deductible once you get past the qualifier.
So if you withdraw a claim, you have no recourse later?
Well, the withdrawal claim would mean that it's there, but it's not there. So all of a sudden, we come back 3 weeks later and we get another 4%, and now we're over that 10%. Now we're in the money. But they don't let that sit there. As a company, they have rules with the state insurance department. They have to withdraw that. It still stays there as a recorded loss, and it's still net at the end of the year. So if we have 2 or 3 losses and we have 4%, 4%, 4%, now we're over that amount, we're still eligible for that hail loss. So still a pretty good deal. Wind endorsements, wind is going up and up and up every year because of our losses. They are going to have a 0 deductible for this next year as it relates to wind. Most of our policies that we've been selling is in that 5% flat deductible or 10% deductible. I think it's going to be priced out of the market, but again, something that you can ask Vince for and see what the rate is on that. We've got a million other plans. Production-based hail plans have been going up over the last couple of years. We've had to switch around and move if it's too much money or doesn't fit in with your budget. And we can do that same thing as we move forward in 2016. I believe there's a buffet of different hail options, and it's figuring out what you're comfortable with. A lot of other endorsements that we have. The one at the top, probably the biggest, is replant option endorsements for 2016. We've had consistently the last couple of years where we've had the opportunity to get in early. Remember, if you're planting before the early plant date on federal crop, you have no replant coverage. So you still have coverage, but if you have to come back in and replant, it's on your own penny. You would not have any federal crop replant coverage. What we have with NAU and RCIS is the ability to sell a replant policy that you can buy 40, 50, 60, even on beets up to $90 or $100 of coverage, so that you can plant early and have something that's going to help you replant, and that's what we have for 2016. NAU is limiting that to 5 days prior to the early plant date. RCIS is sticking their neck out a little bit more and going 20 days before that. And that kind of depends on what we have for opportunity. But still, a pretty good option. Early bird gets the worm has always kind of been the same. And this would give you that option to go ahead and do that. Wind coverage, we talked about canning rejects for if you're doing pea, sweet corn. where if they reject it because of hail, we can add those types of things to your policy. Hybrid seed, sugar beet, wind freeze, fire, if we get dry, we did last couple of years, all of a sudden we're dry, there's combine fires, we can add that pretty quick. It's 2 hours after we get that application into the company, it'll become active. So again, an option for us. Late plant options, we have that with one company, where if we get delayed and we get into our late plant period, there's an opportunity to buy something that would still give you full coverage versus having that coverage be reduced. And our added price option through RCIS is if you think you want more than what that spring price is on your guaranteed bushels, so let's say that price comes out to $3.50, you got 170 bushels of guaranteed yield, we can buy another 50 or 60 cents to bump that up to what you think your production costs are, just in case we have the bushels that get lost would be at something close to your production cost. So again, added features that we have. One last thing, I guess, just to quickly mention, one of my larger customers called the other day, and he says, hey, I've got this marketing guy from Chicago that told me there's a new hot deal on whole farm revenue. Just so you're aware, to go through it and understand what it is, I think it was developed for other producers that are not in this territory, but there may be a niche somewhere in there if we're dealing with livestock or something else. Whole farm revenue developed a year ago, which basically is taking your whole farm and putting it into one unit for one revenue guarantee. So whole farm revenue is guaranteeing you revenue based on your whole operation. So if you've got corn, soybeans, and sugar beets and you're in 3 counties, they're taking all 3 counties, all acres, all crops, all commodities, and throwing that into one revenue guarantee. So I think it's be very challenging to take all of that and throw it into one and have anything at the end of the day that would give you losses and payouts at the end of the day. So the more things you put together, I'm a believer in the enterprise unit on corn, you know, where we're putting some units together to get some discount, but it really becomes challenging for me to wrap around my head when I look at the last, 7 or 8 years, did we really have everything that fell out of bed, or did we have corn that wasn't so good and beans were good? I just think that would be challenging, and if you want to look at this, we'd be glad to sit down and do it, but just to make sure that you're protected at the end of the day is what we're looking at. So again, it's a little more difficult. It's not based on APH, it's based on your last 5 years' taxes. So if you're interested in whole farm revenue, the things that we start with are the 5 years' taxes. That's starting with 2014 on back 5 years. We'll need some inventories for us to tie off 13-14 inventories. The maximum revenue at the 3 commodities, which is where you max out at your 85% on the whole farm revenue, is 10 million. So again, some limitations on livestock, and that's maybe where the fit is with the whole farm revenue. We've got really good coverage on corn, beans, and our other crops, being able to buy that 85%. Maybe it's some swine that you have some risk on, or maybe it's cattle, or maybe it's dairy. That might be where the fit would come, is to overlay the whole farm revenue over the top of your RP coverages on your corn and beans or whatever. So it can be a combination of 2. We just have to piece that together to show you what the cost would be on whole farm revenue. Again, it's going to take taxes, 5 years taxes. We'd have to put together all of these forms. Unfortunately, a lot of the companies don't have this built into the quoting. So we have to get Robbie's expertise to go in and help us put all this into the federal system, which will then give us the opportunity to show you the quote and what that cost would be on that product. The other thing, the last thing, just to show you what we're invested in as we move forward, we believe the drone business is a good thing for us. We've partnered with 2 different crop insurance companies. AgQuest has filed a 333 exemption for us to work with the drones and make them part of our business. A couple things there, loss adjustment. We feel like if we get in a county where we get a lot of wind, we get a lot of hail, we can help those loss adjusters by flying that ahead of time to help them identify where the problems are and hopefully speed up our loss adjustment process. So we're invested in doing that, as well as looking at additional programs over the top of MPCI that we can use the drones to give us higher levels of coverage and the ability for us to do some in-season inspections and/or some growing inspections as we move forward. So we're working hard to try to find some other options for you, because we do know we're on the lending side, we're in the lending business, that things are tough and we need to pump out as much as we can out of every acre. Again, we're invested in that. With that, I want to give Tim Lewis 5 minutes to kind of review and talk about what he's finding on the property and casualty. We're in the property and casualty business. We've done a lot of good for a lot of people the last few years, and just for him to talk about some of the things that don't quite have connected, or issues that you might want to look at. So with that, I do appreciate you taking the time, and we'll be around here for a little while afterwards if you would like to visit.
Thanks, Lynn. Everybody hear me all right? Perfect. As Lynn said, I'm Tim Lewis. I'm part of the property casualty, part of AgQuest, part of the retailers and so forth. And I promise I'll only take 5 minutes of your time. But I've had the opportunity to sit down and talk with a lot of you guys over the past couple of years. And I think one thing we found is that knowledge is quite important when it comes to our farm operation. A lot of times we always thought it was just our combine and our equipment and so forth. So I'm going to talk about today is just the liability portion of the farm contract that I can see a lot of times are being missed, that are very, very important. As a matter of fact, I talked about a couple of them today already. So on the liability side, I know over the last couple of years when I met with a lot of you, we always talked about we're creating entities such as LLCs, partnerships on the farm. It's not no longer just in my individual name. What we're finding is a lot of times we're putting it on the property side, the new named insured, and forgetting on the liability side. And the liability is where you're really going to lose your net worth. The property, you're only going to lose what the value of that product was. But in conjunction to that, where we're really finding things that are being missed again is we're seeing a lot of people creating trusts, whether it be for the wife, the spouse, the children, and so forth. Whenever we create a trust, the trust is something we don't see. It's gone, okay, and we don't think about it. Well, trust is as important as any other entity and so forth, and we need to be listing that trust on our farm liability and property as well, our auto and our umbrella, if in fact our trust are any part of our farm operations. That way we're going to be able to respond in that scenario. So again, the trusts are some of the most important parts right now that we're seeing a difference on. Spring isn't far away. That's what we're talking about today, is getting everything up together and so forth. And every farm policy should have what we call farmers' employers liability coverage on it. Very few of us probably know exactly what that does. So in short, it just simply says if I have somebody come on the farm that I'm going to pay and they get injured, what's going to happen? A lot of people think it's a work comp policy. It is not. And each year the guideline changes. Farmers are not exempt from requiring work comp, but there's a guideline of when you need to. And that new number comes out here at the end of January as far as where that would be. So if you're going to have help on the farm, contact your agents to make sure that you're in compliance, because believe it or not, it goes back to what you have on your farm policy for a liability limit that allows it to make it acceptable in the state of Minnesota and not have to purchase work comp. But there is a big difference between those two products. If you'd like to talk more about that, I'd gladly do so. This year we had some pretty good abundance of grain, and a lot of people had to either put storage in town or pick up that grain bin from the neighbor that hasn't been used in 20 years. The old grain bin, the storage, and so forth. That is a liability location on all farm policies. Whereas right now you put your land acreage and you're out there farming and you have an accident or whatever, we're going to be taken care of. But a bin site is actually a location that you need to list on the policy, so that if we're loading or unloading grain and somebody gets hurt on that location, or when you're not there, because that is now yours. So make sure if you have rented any of those locations that are new to you, you get a hold of your agent and put that location down. It's about a $20 charge. But now basically it says we're going to take our liability from our farm policy and our umbrella if we got it and extend it to that location just in case something would happen. And unfortunately, that is where it's probably going to happen. It's a site you're not familiar with. It's a site we're probably going to have PTOs. It's a site we're probably going to have our hired hands and so forth over there and what have you. So again, make sure we list those locations for that there. One of the other big concerns that we're having in liability is jointly owned farm equipment. Okay? And it used to be that it wasn't a big deal if it was family members that owned it together. But it is creating a lot of issues. It goes back to the named insured liability again. One brother may put it in a trust or an LLC and the other does not. But when that equipment's out on the road, who's going to be liable for it is really what the concern is going to be. Again, so make sure that if you do have joint equipment with other people, your agent is aware of it, but we make sure we annotate it both ways. And also find out, are you picking up somebody else's liability that you don't know? And there's two ways of looking at it. One of them is registered and unregistered. And what I mean by that is I have a piece of farm equipment that I have to register with the state, such as a semi, trailer, and so forth. Make sure that both people that own it are not only on the title, but also on every insurance policy. Because if it's out having an accident or have a claim, somebody else is using it, you're gonna get brought into that suit and not have the proper coverage, thinking that you're picked up under your buddies or the guy you bought it with. Not the case unless we're actually listed on there. If we own a combine together, we have some concerns there as far as how does it go on the policies, again, the liability issues and how it's being used, that type of thing. Custom farming, that has been something that changed in 2013. We talked about it at the last couple meetings on how it has been automatically covered, and then it was excluded, and now it's limited, okay? And what we mean by limited, custom farming under the standard farm policy of Minnesota says it's okay, as long as your agents know that you're doing custom farming, it's listed on there to go out and do some harvesting and tillage. But they are now excluding if you're out there doing custom spraying, anhydrous application, and manure pumping. If you're doing any of those for hire for somebody else, more than likely your standard farm policy is not going to take care of it. And unfortunately, that's probably where some of our claims are going to come into play. Again, with spring coming down, we're going to have a lot of possible help on the farm. We already talked about the farmer's employer's liability. But the other big thing is basically what we call vicarious liability. The vicarious liability in our world is liability that you get brought into that you had no idea, first of all, that you had the exposure, and why am I getting brought into it because I didn't do anything wrong. And what happens on it is if you have a farm employee or a friend, relative, neighbor, or me here today, it doesn't matter. We're out working on the combine, we need a new belt, you send me into town to get that new belt, and I hop on my car and I take off. I can guarantee you, the only thing I'd ever bet on, to be honest with you, is that you didn't ask that guy if he had insurance for his car. Okay, why would you? You just want to get your combine back. So when you actually direct somebody for your farm operation to go off premise on their own vehicle, you can be liable for it, and we find it all the time. So he gets involved in that auto accident, and he's going to be primary. That individual will be first. And they're going to ask him, what were you doing? I mean, it's a very simple question. I was running parts. I was trying to get it for Joe Blow. Oh, okay, mark it down and so forth. And all of a sudden the claim gets a little worse, and the guy's liability limits are either depleted or it didn't happen. You're automatically in line for that next lawsuit because he was on the road as a result of you. It happens within family members. So under a farm policy, you can purchase what they call extended non-owned auto coverage on an auto policy if you have a commercial policy. Not all farmers out here will have a commercial policy. State Farm doesn't have the proper commercial farm policy on auto, but they can add it to their general liability of the farm. Again, it's called extended non-owned auto. And all that simply says is if somebody's running errands on your behalf using their automobile, not yours, and involved in a claim, and they bring suit back to you, it now says we're going to respond for you, not that individual, and all of your policy limits will be applicable. So again, that's extended non-owned auto. It's very inexpensive. It's something that we see missed on a lot of policies. It's something we put on every policy, even when you tell me you don't have the exposure. Because you may not have the exposure today, but you will tomorrow, and you don't know about it. And the last one that's really coming around today on the liability side, and you guys are going to kind of laugh because I sure did. I had to read it at least 10 times to understand what it meant. And I've been in the business for 26 years. And if it took me 10 times to read it, I can guarantee you you're using it to start your fireplace. And what it is liability for personal injury. And it's something that's on our policies. And it just simply says we have liability if I hurt somebody. I can see that I broke their arm. But we also have what you call personal injury. And personal injury says you hurt my feelings. Okay? You call me a knucklehead in front of my daughter, or whatever it may be, all right? It happens, unfortunately, okay? You walk in on somebody, false invasion of privacy, false arrest, all that type of stuff. That's covered under our policies, it's covered under our straight farm policies, and then we pick it up under our umbrella. Right now, February of this year is the first one that I've seen that's going to start excluding what they call cyber liability under the umbrella zone. Right now, we're still having it under the farm liability, but I think it's going to trickle on down. And actually, when I was reading, I started laughing. I said, wow, what's the big concern for me? And the cyber liabilities, I get on my Facebook page, I get on my emails, I do all that type of stuff, and now I'm offending somebody through the waves. Okay, that's called cyber liability. They're now gonna exclude that for coverage. They're gonna say we're no longer gonna pick that up. And as I was sitting here, as I did, I started laughing. I said, well, okay, not a big deal. I can control my risk. You know, I can control if I'm gonna drive out in a snowstorm or not. What I didn't think about is I can't control what my daughter does or my children when they're at school because they're insured under your policy. So cyber liability is huge in the younger generation. Huge. And you see it every day. And now because of the parents, you're subject to your responsibility for your child. So look at your farm policies, talk to your agents, find out if you can have cyber liability coverage or not. As of right now, there's no way to buy it back. They're just gonna exclude it under the umbrella, or we're gonna work on it coming around. So don't call anybody a knucklehead in person or over the airwaves, and you all should be okay. I promised only 5 minutes, and I took a few more than that, but thank you very much.